Continuing from the previous day's discussion, I your host Harshit Simha. Today we discuss on annual disclosures, Secretarial Audit and Sustainability Reporting under Securities and Exchange Board of India SEBI, Master Circular on Listing Obligations and Disclosure Requirements, LODR, compliance as of the 30th of January 2026. This represents a significant advancement in strengthening governance and ESG integration within listed entities. Secretarial audit disclosures serve as a critical assurance mechanism, enabling an independent evaluation of a company's compliance with applicable laws, regulatory requirements, and governance standards. By mandating structured and periodic reporting, SEBI reinforces the role of company secretaries as key gatekeepers of compliance, risk management, and ethical corporate conduct. These disclosures not only enhance regulatory oversight but also promote investor confidence through greater transparency and accountability. Equally important is the emphasis on sustainability reporting, which reflects the growing alignment of Indian capital markets with global environmental, social, and governance (ESG) expectations. The framework encourages listed entities to integrate sustainability into strategic decision-making, risk assessment, and stakeholder engagement. Collectively, these annual disclosures foster responsible business practices, improve long-term resilience, and contribute to sustainable and inclusive economic growth, thereby reinforcing India's commitment to high standards of corporate governance and responsible capitalism. Slide 2. Annual Secretarial Audit and Compliance Reports. The requirement for annual secretarial audit and compliance reports represents a cornerstone of regulatory oversight under 24A and corporate governance under the SEBI LODR framework. These disclosures are designed to ensure that listed entities adhere to applicable statutory, regulatory, and governance standards in a structured and transparent manner. The annual secretarial audit is conducted by a practicing company secretary in accordance with the prescribed reporting format, providing an independent and objective assessment of the company's compliance with securities laws, corporate regulations, and governance practices. Importantly, this requirement also extends to material unlisted subsidiaries incorporated in India, thereby ensuring comprehensive oversight across the entire corporate group. In addition, listed entities are required to submit an annual secretarial compliance report to the stock exchanges within the specified timeline after the close of the financial year. This report confirms compliance with SEBI regulations and highlights any deviations, non-compliances, or regulatory observations, along with the corrective measures undertaken by the company. The process enhances regulatory monitoring, promotes accountability, and supports proactive risk management. Furthermore, listed companies are expected to provide all relevant documents and information to the practicing company secretary to facilitate accurate certification. Collectively, these requirements strengthen internal controls, reinforce ethical corporate conduct, and enhance investor confidence by promoting transparency, integrity, and sustainable governance practices. Slide 3. Business Responsibility and Sustainability Reporting. Business Responsibility and Sustainability Reporting (BRSR) represents a progressive and structured approach to corporate disclosure, enabling organizations to demonstrate their commitment to responsible, ethical, and sustainable business practices. The BRSR framework, introduced for the top 1,000 listed entities by market capitalization, mandates comprehensive transparency in environmental, social, and governance (ESG) performance. It encourages companies to move beyond conventional financial reporting by integrating sustainability considerations into their strategic and operational decision-making. Voluntary adoption by other entities further promotes widespread accountability and comparability across industries. At the core of BRSR are the 9 principles of the National Guidelines on Responsible Business Conduct, NGRBCs, which provide a holistic foundation for responsible governance. These principles encompass ethical conduct, sustainable product and service delivery, employee well-being, stakeholder engagement, human rights, environmental stewardship, responsible value chains, consumer welfare, and inclusive growth. By aligning corporate conduct with these principles, organizations enhance resilience, strengthen stakeholder trust, and contribute meaningfully to sustainable development goals. Reporting indicators under BRSR include essential and leadership metrics. Essential indicators ensure standardized, comparable disclosures, while leadership indicators encourage advanced, voluntary reporting. Together, they facilitate robust sustainability assessment, foster transparency, and support informed decision-making by investors, regulators, and society, thereby reinforcing long-term value creation. Slide 4. BRSR Objectives, Benefits and Enhanced ESG Metrics. The Business Responsibility and Sustainability Reporting (BRSR) framework is designed to advance transparency, comparability, and accountability in corporate sustainability disclosures. By introducing standardized ESG parameters, BRSR enables consistent evaluation of listed entities' performance, thereby facilitating informed decision-making by investors and stakeholders. It ensures that sustainability reporting moves beyond narrative commitments to structured, measurable disclosures aligned with nationally recognized principles. Importantly, BRSR enhances comparability across companies, encouraging organizations to look beyond financial outcomes and assess their broader social and environmental impact. Listed entities already publishing sustainability reports under internationally accepted frameworks, such as DRHs, SASB, or TCFD, are encouraged to map their disclosures to the BRSR format, promoting harmonization and global alignment. At its core, BRSR strengthens ESG assessment through enhanced metrics that are increasingly relevant to emerging market contexts like India. Key indicators include job creation, particularly in small towns and across wage bands, reflecting socioeconomic inclusivity, business openness, assessing transparency and stakeholder engagement practices, and global comparability, such as intensity ratios based on revenue-adjusted purchasing power parity (PPP). These refined metrics provide deeper insights into responsible growth, resilience, and long-term value creation. Collectively, BRSR positions ESG performance as a strategic driver of sustainable and inclusive corporate development. Slide 5. BRSR Core Implementation Glide Path. The BRSR Core Implementation Glide Path outlines a phased and structured approach for mandatory assurance and assessment of the BRSR Core framework, ensuring a smooth transition toward enhanced ESG accountability. This calibrated rollout reflects regulatory prudence, allowing listed entities to progressively strengthen their sustainability reporting and assurance mechanisms. Beginning in FRE 2023-24, the requirement applies to the top 150 listed entities by market capitalization. In FRE 2024-25, the scope expands to include the top 250 entities, followed by the top 500 entities in FRE 2025-26. By FY 2026-27, the mandate will encompass the top 1,000 listed entities, thereby significantly broadening the coverage of standardized ESG disclosures across India's corporate landscape. This four-stage implementation trajectory balances preparedness with regulatory rigor, enabling organizations to develop internal systems, data governance frameworks, and verification processes aligned with BRSR core requirements. Additionally, industry standards have been formulated under the aegis of stock exchanges, in collaboration with industry bodies such as ASSOCHAM, CII, and FICCI, to facilitate uniform interpretation and execution. These standards are applicable from FY 2024-25 onwards, reinforcing consistency and comparability. Collectively, the glide path underscores a strategic commitment to embedding sustainability assurance within mainstream corporate governance, fostering transparency, credibility, and long-term stakeholder trust. Slide 6. Value Chain ESG Disclosures and Assurance Standards. The framework for value chain ESG disclosures and assurance standards significantly expands the scope of sustainability accountability beyond the reporting entity to its broader ecosystem of partners and suppliers. Listed companies are required to disclose BRSR core parameters for their value chain partners, specifically those accounting for 75% of purchases and 75% of sales, by value. This threshold ensures that disclosures meaningfully capture the most material upstream and downstream impacts while maintaining practical feasibility. The requirement is applicable to the top 250 listed entities from FY 2025-26 onward, with assessment or assurance becoming voluntary from FY 2026-27. Notably, during the first year of reporting, disclosure of previous year comparative numbers remains voluntary, allowing organizations time to build reliable data systems and supplier engagement frameworks. Equally critical are the assurance provider requirements, which safeguard the integrity and independence of ESG verification. The board must ensure that the appointed assurance provider possesses the requisite expertise and credentials to undertake BRSR core assessments. To prevent conflicts of interest, the assurance provider must not sell products or offer non-audit, non-assessment, or consulting services to the listed entity or its group companies. Together, these provisions strengthen transparency, reinforce credibility, and promote responsible value chain governance aligned with global ESG best practices. Slide 7. Disclosure requirements for listed entities. The disclosure requirements for listed entities are anchored in the principles of transparency, timeliness, and materiality, as mandated under Regulation 30 and 30A of the SEBI, Listing Obligations and Disclosure Requirements, Regulations. These provisions require listed companies to promptly disclose material events and information that may influence investor decision-making or impact market integrity. The objective is to ensure that stakeholders have access to accurate, adequate, and reliable information, thereby fostering trust and minimizing information asymmetry. Regulation 30 specifically obligates entities to disclose events specified in Part A of Schedule 3, including those deemed material based on defined criteria. Even where materiality thresholds are not explicitly prescribed, companies must exercise sound judgment in determining disclosures that could reasonably affect the valuation or perception of the enterprise. Regulation 30A further strengthens the framework by mandating disclosure of agreements that impact management or control, including shareholder agreements and other binding arrangements. To support effective implementation, industry standards have been formulated by ASSOCHAM, CII, and FICCI under the aegis of stock exchanges. These standards provide structured guidance for uniform interpretation and application of disclosure obligations. Collectively, the framework reinforces governance discipline, enhances market confidence, and aligns corporate conduct with regulatory expectations and global best practices in transparency. Slide 8. 4 Key Annexure Guide and Default Disclosures. The regulatory framework governing disclosures for listed entities is further strengthened through 4 key annexures: Annexure 18, Annexure 18A, Annexure 19, and Annexure 19A, each serving a distinct interpretative and operational function. Annexure 18 specifies detailed disclosure requirements for events enumerated in Part A of Schedule 3, ensuring clarity and completeness. Annexure 18A outlines guiding principles for determining materiality when disclosing events under the same schedule. Annexure 19 addresses the disclosure of events or information deemed material by the entity, even if not explicitly prescribed, reinforcing the principle of substance over form. Annexure 19A provides objective criteria for assessing materiality, thereby promoting consistency and reducing interpretational ambiguity. Listed entities are required to provide reasoned justifications where disclosures are withheld and must ensure parity of information across jurisdictions. Any material disclosure made overseas must be simultaneously disclosed on Indian stock exchanges. In addition, default disclosures relating to loans and debt securities mandate transparency regarding payment obligations to banks, financial institutions, and debenture holders. A default is defined as non-payment of interest or principal on the due date, including continuous excess over sanctioned limits for more than 30 days in revolving facilities. These provisions collectively enhance financial transparency, investor protection, and regulatory accountability. Slide 9. Verification of market rumors. The verification of market rumors framework, introduced under Regulation 30(11) of the SEBI Listing Obligations and Disclosure Requirements, Regulations, strengthens market transparency by mandating timely confirmation or denial of material rumors. The provision applies in a phased manner based on market capitalization. Effective June 1, 2024, the requirement became applicable to the top 100 listed entities. Subsequently, from December 1, 2024, its scope was extended to the top 250 listed entities, next 150. This calibrated rollout ensures preparedness while reinforcing accountability among systemically significant companies. Under this framework, listed entities must verify market rumors reported in mainstream media that result in material price movements and disclose appropriate clarifications on stock exchange platforms and their official websites. The objective is to mitigate misinformation, reduce speculative volatility, and safeguard investor interests through prompt and accurate communication. Importantly, for transactions subject to SEBI or stock exchange pricing norms, the unaffected price may be considered if the rumor is confirmed within 24 hours of the trigger of a material price movement. The methodology for determining such unaffected price is prescribed under Annexure 19A. Collectively, this regime enhances corporate responsiveness, strengthens information symmetry, and upholds the integrity and efficiency of India's capital markets. Slide 10. Timing and format of default disclosures with quarterly default reporting requirements. The framework governing the timing and format of default disclosures mandates prompt and structured reporting to ensure transparency in instances of financial stress. In the case of loans from banks and financial institutions, disclosures must be made within 24 hours from the occurrence of default. Such disclosures are required where defaults continue beyond 30 days and must comprehensively include the name of the lender, date of default, current default amount with principal and interest bifurcation, details of obligations, principal, interest rate, security, total outstanding borrowings, and total financial indebtedness. For unlisted debt securities, disclosure must likewise be made promptly, but not later than 24 hours from the occurrence of default. The format requires details such as type of instrument with ISIN, number of investors as on the default date, date of default, current default amount, obligation particulars, issue size, tenure, coupon, security, redemption, and total amount issued and outstanding. This standardized reporting structure enhances investor awareness, strengthens credit risk assessment, and promotes accountability in financial disclosures. The quarterly default reporting requirements impose a continuing disclosure obligation on listed entities to ensure sustained transparency in respect of financial defaults. Where any default in repayment of loans or servicing of unlisted debt securities subsists as on the last date of a quarter, the entity is required to report such status in its quarterly financial results submission under Regulation 33. The disclosure must provide a consolidated view of outstanding defaults, including the total amount outstanding and the defaulted amount as of the reporting date. For loans and revolving facilities, entities must specify the aggregate outstanding liability and the portion remaining unpaid. In the case of unlisted debt securities, the report must include the total amount issued, outstanding, and the defaulted component. Additionally, total financial indebtedness, encompassing all short-term and long-term borrowings, must be disclosed to provide contextual clarity. This structured quarterly reporting enhances credit discipline, supports informed investor assessment, and reinforces regulatory oversight through consistent and periodic financial transparency. Slide 11. Asset classification and provisioning divergence. The framework on asset classification and provisioning divergence enhances transparency within the banking sector by mandating timely disclosure of material divergences identified by the Reserve Bank of India, RBI. Unlisted banks are required to disclose such divergences within 24 hours of receiving the RBI's Risk Assessment Report, RA, rather than deferring disclosure until the publication of annual financial statements. This accelerated timeline underscores the importance of prompt communication of price-sensitive information to stakeholders. Disclosure becomes mandatory where specified quantitative thresholds are breached. These include instances where the additional provisioning for non-performing assets, NPAs, as assessed by the RBI, exceeds 5% of the reported profit before provisions and contingencies for the reference period, or where the additional gross NPAs identified exceed 5% of the reported incremental gross NPAs. By prescribing objective thresholds and strict timelines, the framework strengthens supervisory oversight, mitigates information asymmetry, and reinforces market discipline. It ensures that investors and regulators are apprised of material asset quality variations in a timely and consistent manner. Slide 12. Statutory Auditor Resignation. Key conditions. The regulatory framework governing statutory auditor resignation prescribes stringent conditions to safeguard investor confidence and ensure continuity of financial reporting. Where a statutory auditor of a listed entity or its material subsidiary proposes to resign, specific compliance requirements must be fulfilled to prevent disruption in audit oversight. If the resignation occurs within 45 days from the end of a quarter, the auditor is required to issue the limited review or audit report for that quarter before stepping down. In cases where resignation takes place after 45 days from the quarter end, the auditor must complete and issue the limited review or audit reports for that quarter as well as for the subsequent quarter prior to resignation. Furthermore, if the resignation is tendered after signing the limited review report for the first 3 quarters of a financial year, the auditor is obligated to finalize and sign the audit report for the entire financial year. These conditions reinforce accountability, prevent abrupt audit discontinuity, and uphold the integrity of financial disclosures. Slide 13. Auditor Concerns and Reporting Obligations. Auditor concerns and reporting obligations constitute a critical pillar of corporate governance, reinforcing transparency, accountability, and stakeholder confidence. When auditors identify concerns such as non-availability of information or lack of cooperation by management that could materially affect the audit process, they are obligated to promptly report such matters to the audit committee. This direct reporting ensures that governance bodies remain fully informed and can take corrective measures in a timely manner. Furthermore, if the issues remain unresolved, auditors must escalate them to the board of directors, thereby strengthening oversight and reinforcing ethical conduct across the organization. In addition, auditors are required to maintain comprehensive documentation of all relevant discussions, evidence, and communications. This includes recording any information or explanations sought but not provided by management. Where adequate audit evidence cannot be obtained, appropriate disclaimers must be included in the audit report in accordance with prescribed standards. The audit committee must then deliberate on these concerns and communicate necessary actions. Listed entities are expected to incorporate these provisions in auditor appointment terms, while practicing company secretaries must certify compliance in annual secretarial reports. Slide 14. Post-Resignation Disclosure Requirements. Post-resignation disclosure requirements are designed to strengthen corporate transparency and ensure continuity in governance following the resignation of statutory auditors. Upon resignation, listed entities are mandated to obtain detailed information from the outgoing auditor in the prescribed format and disclose such information to the stock exchanges within 24 hours. The audit committee is required to deliberate on all concerns highlighted by the auditor at the earliest possible stage, and no later than its subsequent meeting, thereby reinforcing proactive oversight and accountability. Further, the board of directors must thoroughly examine the issues raised and provide clear, reasoned responses, including any remedial actions proposed or undertaken. Where the information relates to audit or limited review matters, the views of the audit committee must also be disclosed to stakeholders within the stipulated timeframe. These disclosures enhance investor confidence by ensuring that material governance concerns are transparently communicated. Importantly, these requirements operate in addition to obligations under the Companies Act, 2013, and are not applicable where auditors are disqualified under the relevant statutory provisions. This brings us to the conclusion of Part 2 of the SEBI Master Circular on LODR compliance for annual disclosures, Secretarial Audit and Sustainability Reporting. In the forthcoming session, next we will commence Part 3, focusing on other obligations and disclosures requirements under the SEBI Master Circular on LODR compliance, as updated on the 30th of January 2026. We encourage you to remain connected with our channel, actively engage with the content, and share these insights within your professional networks. Your continued support and recognition, through subscribing and enabling notifications, are deeply appreciated. We extend our sincere gratitude for your sustained engagement and participation. We wish all our viewers continued success, along with a happy, healthy, and prosperous journey ahead. Until we meet again, thank you and goodbye for now.